Hello again and welcome to this week's video briefing. The subject today is back in the area of Euro woes. We're thinking about these issues in the context of the summit of European leaders, which is due to take place next Thursday and Friday, at which much is expected. Now, who better to explore some of the Euro woes and possible solutions with than my colleague Vanessa Rossi, a senior contributor on the global macro scene for us. Vanessa, as we came into the studio to do this recording, we had May figures for purchasing managers' indexes, and they were rather gloomy. They were back in negative territory, well rather they stayed in negative territory, and I think we saw some slippage even in Germany. So Q2 is looking a pretty grim picture, isn't it?
Yes, I'm afraid all the survey indicators point to unrelieved gloom through the second quarter. This latest survey actually takes us through to June, and this is again confirming the May picture we saw with the slide down to levels that normally indicates recession. Yes. And so expectations of weakness continuing, and probably in Germany too. Against this background, here we are struggling post G20, looking ahead to the European summit with what types of packages can European leaders come through with that can help to address this problem, because it isn't simply a question of finding financial packages to cope with the debt crisis as we know it now. Right. But against this economic background, that debt crisis will get worse and will become far less containable. And so there is also an urgent need to address this underlying economic issue.
Some attempts have been made in the distinct context of the UK to try and address this problem, providing some lending at favourable rates for the SMEs, because it is the SMEs, isn't it, pretty well across Europe, from which growth, when it comes, if it's going to come, is to be looked for, and they must be fed, they must be watered, and they must be tended. Is there some opportunity for replication of UK-type policies on the wider European canvas?
I think so, and I think there's a constituency receptive to that. Clearly there are two steps to the monetary policy approach. One is, of course, the injections of liquidity to keep banking systems flowing, yes, and to prevent financial mayhem. But the second part is actually to push through this money and credit into particularly the SME sector. In Europe, in fact, the SMEs represent something like 60% of the economy, but even as much as 2/3 of jobs. And most of the job creation comes from here. So if we don't get this sector moving, as you say, water it a little and hope it will spring up and grow, then we have very little chance of creating truly private, self-sustaining jobs in Europe. I think there's a great wariness of going into public sector job creation schemes, because while this immediately provides a job, it doesn't help to supply the finance to keep that sustainable and keep it moving along in the future. So we need to be able to grow this private business sector that will deliver that growth, new technologies, new ideas, new businesses, new jobs for the future. Yeah. And this is at least one way that you can go about it. Now, there's a lot of sceptics in the UK about this approach. Of course, offering the cheap credit is one thing, but will it actually go out there and help, yep, and will it actually do the things we want it to do? Well, there's at least a little bit of evidence for this, and I think that's extremely helpful if the rest of Europe is listening and looking at this. Over the last 6 months or so, the UK economy has actually continued to produce new private sector jobs in spite of the fact that we're in recession, which is actually quite extraordinary. And I would suggest that at least part of that could have been related to those efforts to stimulate this credit to the SMEs back last November. So I think modest signs that some of these things, the watering of that SME sector, can begin to bear a few shoots, even in difficult circumstances, and actually a very cheap policy to pursue, because this is all done through credit, most of which you will hope to be repaid. Only the part that will perhaps ultimately not be repaid might you then be liable for, and this helps to give you a form of fiscal stimulus on the cheap.
It's nice to hear a sort of slightly more positive aspect to the discussion, because very often we are talking about problems which seem to have no immediate solution. I'm afraid we must stay in that territory for a moment and just think about what has been discussed quite widely in the media this week, which is the use of the bailout mechanism, that's to say the one that exists now and supposedly temporary, and the one that is due to come into effect 2014, to buy bonds, to buy them not only in the primary market but in the secondary market. There's a lot of Spanish interest in that, Italian interest in that, not much German interest in it, I don't think.
No, but it does seem as if there's been a push towards that camp to using this money in this way. Now, this doesn't actually mean there's a lot more money. It simply means that the money will be used in a different way. It also means that by pushing the money in through this route of supporting the market, they can avoid the tag of being in a bailout,
yes,
which is perhaps psychologically important, not only for the countries, but possibly for markets and for the exit from this process. So if they see this as a relatively temporary problem that they can overcome with relatively small-scale operations within the bond markets themselves, it can certainly help to alleviate immediate pressure. It can buy some time. The difficulties you have with this approach is that these funds are quite limited at the moment. The bailout funds available, the SM and its successors, are not going to be that large. So compared with the size of the bond markets for Spain and Italy of something like $2–3 trillion, the amount of money that may be available to support those markets is quite puny. And so we know that this cannot be even a medium-term policy. It can only be a short-term stopgap. And I think we have to be very careful about whether we think that can do anything to resolve underlying problems. So it's just like going to the doctor. Part of the idea of which medicine you take is whether you've got a short-term problem or a long-term problem. And I think here this particular idea of purchasing bonds in the market is very much a short-termist approach.
Finally, Vanessa, let's just sort of stand back a little bit and look at the European project at one or two removes. It was very much advanced as a social market model for the rest of the world, wouldn't appeal to everybody in every circumstance, but would have enough to make it worthy of emulation, make it worthy of aspiration, make it worthy of membership on the part of peripheral and adjacent countries. That whole issue is, of course, now looking very different. It's in a different light. It's looking much less attractive. It's not far from the brink of collapse as a model, isn't it?
I think it's just about hanging in there, but it wouldn't take very much more to push it over the brink. Compared to some other models, it still has looked attractive. It still probably is. But if we're looking some 5 to 10 years out, if we cannot resolve these debt problems in Europe, and if you look at the difficulties of very slow growth and how that can embed further debt problems down the road rather than actually improving the situation, then I'm afraid that there will be a very serious question mark about how you operate these types of economies, the market socialist mix, as you were, that perhaps has lain behind some of this tendency to have very high deficits and debt results. Now, if we take the examples of where it's worked, we know that, for example, for the case of Sweden, which is held up as being a very successful economy even today, low debt, it's working, it's growing, even in Sweden some years ago, there had to be a major reassessment of how they operated public finances, the social economy, which types of subsidies and help they gave, how to gear up productivity in the economy again. So I think this gave us the idea that social market economies need a little kick up the pants every now and then to keep them going. And if they don't get that, then they tend to sort of slope off into lower growth, lower productivity and larger debt problems. So we rather have the impression at the moment that many countries in the Eurozone are perhaps in danger of relying too much on the social part of the model and not enough on looking at the way in which you grow the market part of that model. And if you don't get these two working together, unfortunately you don't have the money to pay for the social things that you would like. So taking those lessons from Sweden, I think, is quite important. I understand that there have been many discussions in Germany in the last few years about this particular case, and I think the messages from it are something that needs to be understood on a wider European scale. If this whole European concept is really going to move forward, not just limping forward, not just struggling to even make it, but actually move forward in a more successful way.
Thanks very much, Vanessa. I do hope you've enjoyed this discussion. Just a small example of the insights and analysis we provide to our clients on the European and the global situation generally. As far as Europe's concerned, I'm very pleased to say we've launched a Europe Compass service specifically focused on the travails of the Eurozone and designed to help you understand them and to manage your investment and other strategies accordingly. For information about that service or indeed about anything else that we do at Oxford Analytica, do look at our website and get in touch. We'd be delighted to hear from you. In the meantime, thanks very much.